Hey everyone, I'm Doris and welcome to my channel. Today I'm going to review the 7 meetings of the Federal Reserve and talk about how the Fed fights inflation. The U.S. Federal Open Market Committee (FOMC) raised interest rates from 0.25% to 4.5% at 7 consecutive meetings from March to December this year, the fastest tightening action implemented by the Fed since the 1980s. Typically, the Fed only adjusts interest rates by 25 basis points at a time. This year, the Fed has raised interest rates by 50 basis points or more in 6 of its 7 rate hikes, including 4 consecutive meeting hikes of 75 basis points. On 4 separate occasions, Fed Chairman Jerome Powell used his post-meeting speech to emphasize the importance of the Fed's acting quickly to curb demand and contain inflation. At its final meeting of the year, the FOMC relaxed its gas pedal slightly, opening for a rate hike of just 50 basis points, and Powell said he did not expect a sharp rate hike in the coming year. Of course, he noted, it depends on changes in economic conditions. In hindsight, the Fed's initial plans to cool the economy seems trivial. On March 16th, after its second meeting of the year, the FOMC raised interest rates by 25 basis points, the first time this year the Fed has raised interest rates since 2018. At that time, the FOMC expected 6 more similar rate hikes, with a year-end rate of about 2%, which would be 100 basis points higher than the FOMC expected at the end of 2021. After the meeting, Powell said that the Fed has signaled a rate hike for months and that financial market had made the necessary adjustments, a factor he said would accelerate the tightening effect of policy adjustments. These adjustments have been reflected in market pricing for months, so we will see some of these changes in the second half of the year as time goes by, he said. May, rapid adjustment. As inflation continues to remain at a 40-year high, the FOMC implemented its first ultra-large rate hike of the year in May, raising the policy rate by 50 basis points. This is the first consecutive rate hike by the Fed since 2006 and the largest since 2000. The Fed also rolled out a program to begin shrinking its balance sheet by allowing treasuries and mortgage-backed securities to mature without replacement. This meeting marks the beginning of the Fed's move to rapid tightening monetary policy. Inflation is too high. We understand the difficulties it creates and we're moving quickly to bring it down, Powell said. For the sake of American families and businesses, we have both the necessary means and the determination to restore price stability. Powell noted that a further 50 basis point rate hike might be necessary at subsequent meetings, but at a larger hike is not something the committee is actively considering. June big move adjustment. As price index continues to move in the wrong direction, the Fed took an aggressive move at its June meeting. The Fed raised its benchmark interest rate by 75 basis points. The rate hike was the largest since 1994. The Fed has raised interest rates by 150 basis points in just 3 months, raising concerns about some in the economy about the potential effect of financial stability. Kansas Fed president and 2022 voting member George voted against raising interest rates too quickly due to concerns about the Fed's rate hike. George said in a written statement at the time, the impact of policy changes on economy is lagging, and major and abrupt changes can make households and small businesses uneasy as they make necessary adjustments. This will also have an impact on the yield curve and traditional bank lending models, such as those commonly adopted by community banks. Powell acknowledged that the hike was very large, and said he did not think such a sharp hike would become a norm. However, he added that a 50 or 75 basis point hike is expected at the next month's meeting. June also marks the beginning of the Fed's balance sheet reduction, allowing $47.5 billion per month in assets to be reduced, the Fed's first quantitative tightening since 2019. July continued rate hikes of 75 basis points. The FOMC did raise rates by another 75 basis points at its next meeting. After this rate hike, the target range for interest rates is 2.25% to 2.5%, bringing interest rates higher than a year-end rate expected in March and also above the Fed's long-term inflation target of 2%. Although widely expected ahead of the meeting, the rate hike has heightened concerns about financial stability, with some economists worried that such rapid changes could lead a credit event within larger financial institutions or a sovereign debt crisis in another part of the world. Powell sidestepped those concerns, saying the U.S. economy was strong enough to absorb the impact of rising interest rates and that banks were in good shape. From a financial stability perspective, asset values have gone down, which in a sense reduces vulnerability. Only when the stock prices are really high, you worry that they can easily fall. Many assets have fallen in value. I think you have a well-capitalized banking system. I think households' finances are as strong as they have been in a long time. Or given the money on people's balance sheet, their finances could be unprecedented strong. Powell said, so from a financial stability perspective, you're in a pretty good scenario. September, purposeful adjustments. In September, the Fed raised interest rates by another 75 basis points, bringing interest rates above 3% for the first time since 2018. Powell removed the word SWIFT from his post-meeting statement, but noted that FOMC is still taking decision to make monetary policy less accommodative. We intend to adjust our policy stance at a level that is restricted enough to bring inflation back to 2%, he said. A week after rate hikes, Fed Vice Chairman Brainard gave a speech on how rising U.S. interest rates are affecting global monetary policy and how the U.S. can feel the ripples of financial instability elsewhere in the world. The global environment of Qualcomm's inflation and rising interest rates highlights the importance of monetary policy focused on financial stability factors, Brainard said. As global monetary policy tightens to combat high inflation, it is important to consider how cross-border spillovers may interact with financial vulnerabilities. September was also a notable month for the Fed to reduce its balance sheet, with the monthly reduction cap increasing to $95 billion. Powell pointed out that the Fed's financial swelled to nearly $9 trillion during the pandemic, and that in order to reduce the size of assets, the Fed may need to sell assets at some point, not just let them mature, but said that this will not happen anytime soon. How the Fed reduces its balance sheet is a matter of great concern to banks, which rely on central banks to provide liquidity. November, attractiveness of the fourth rate hike of 75 basis points. Despite concerns among economists about the impact of monetary policy so far, and resistance from lawmakers, the Fed raised interest rates by 75 basis points for the fourth time in November. The hike pushed the Fed's target rate range to 3.75% to 4%, the highest since January 28, 2008. In his prepared speech, Powell again said, the Fed is acting purposefully to make monetary policy restrictive enough. Powell also said the committee has succeeded in raising interest rates quickly, but noted that it will note the accumulated tightening before implementing future rate hikes, leaving room for a slower pace of adjustments at the next or subsequent meetings. December, duration is more important than the pace of rate hikes. Finally, at its December meeting, the FOMC slightly slowed the pace of tightening monetary policy, raised rates by only 50 basis points. Powell said the Fed would like to see how the economy reacts to the rate hikes implemented so far, noting that monetary adjustments have lagged in many areas of the economy. He added that 50 basis points is still a historic and substantial rate hike, while future rate hikes may be necessary. A survey of FOMC members suggests the Fed will hit a terminal rate above 5% sometime next year. Powell said the rate at which the federal fund rate peaks is less important than how long it stays there. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.